Not financial advice. This is for educational purposes only. Do your own research. Now let's talk. I want to start by asking you something that might sound uncomfortable. When was the last time you felt this uncertain about money? Not just about Bitcoin, about everything. About your savings, about interest rates, about whether the system you've trusted your whole life is actually as stable as they told you it was. If you're being honest with yourself, the answer is probably right now. And I think that discomfort, that creeping, low-grade anxiety that something fundamental has shifted, is actually one of the most important signals in the market today. Because throughout history, the moments of maximum confusion in the financial system have almost always been the moments where the next chapter was being quietly written. The people who understood what was happening didn't panic. They studied, they positioned, and then they waited. That's what this is about. Not hype, not a price prediction, not a promise that Bitcoin goes to some number that makes you feel better. This is about context. This is about understanding what's actually happening in the global financial system right now, why Bitcoin fits into that picture in a way that nothing else does, and how to think about this moment, not emotionally, but structurally. So let's start where every serious financial conversation should start, not with a price chart, but with the bigger machine underneath. We are living through something that happens roughly once every 2 to 3 generations. Ray Dalio calls it a long-term debt cycle. It's not a theory. It's a pattern that has repeated throughout human history, from the Dutch Empire in the 1600s to the British Empire in the late 1800s to the United States-led financial order built after Bretton Woods in 1944. Every great empire, every reserve currency, every dominant financial system eventually reaches a point where the debt it has accumulated becomes larger than its productive capacity to service that debt. When that happens, not overnight but over years, the system starts bending. Interest rates get manipulated. Currency gets devalued. Trust in institutions erodes. And people start looking for stores of value that can't be diluted by the decisions of politicians or central bankers. We are at that point right now. The United States national debt has crossed $36 trillion. The interest payment on that debt alone now exceeds the entire defense budget. The Federal Reserve has spent the last 15 years printing money in quantities that were literally unimaginable before 2008. Global central bank balance sheets expanded from roughly $6 trillion before the financial crisis to over $30 trillion by the early 2020s. And here's the thing that most people don't fully absorb, is that money didn't disappear. It's still in the system. It went into asset prices, into real estate, into equities, and increasingly into Bitcoin. The inflation you felt at the grocery store, the rent increases you've watched happen in real time. That's not bad luck. That's math. When you expand the money supply faster than you expand productive output, each unit of currency buys less. That's not a conspiracy. That's arithmetic. Now I want to connect this to history because that's where the fear actually starts to dissolve. In 1929, the stock market crashed. 79% of its value was wiped out over 3 years. Banks collapsed. Breadlines formed. People who had worked their entire lives saw their savings evaporate. The fear was so total, so pervasive, that most people at the time genuinely believed the American economy would never fully recover. They were wrong. By 1954, the market had not only recovered, but surpassed its 1929 peak. The people who held quality assets through the worst years and didn't panic, they were fine, more than fine. In 2008, Lehman Brothers collapsed. Bear Stearns was gone. The entire global banking system was 48 hours away from complete seizure, according to people who were in the room. The S&P 500 fell 57%. Housing prices crashed. Unemployment hit 10%. And again, the fear was existential. This time, people thought capitalism itself might be ending. Instead, what happened? The Federal Reserve printed $4 trillion, asset prices recovered, and the decade that followed was the longest bull market in American history. Now here's what I want you to notice about both of those moments. In 1929 and 2008, the people who held cash under the mattress, who let fear paralyze them, who waited for certainty before acting, they missed the entire recovery. And the people who studied the structure, who understood what the Federal Reserve was likely to do, who recognized that governments don't let the financial system collapse without fighting back with every tool they have, those people were positioned. Bitcoin's own history has the same pattern. In 2011, Bitcoin lost 94% of its value, from $32 to $2. People said it was dead, tulip mania, Ponzi scheme. It came back. In 2013, it ran to over $1,000, then collapsed 87%. Dead again. It came back. In 2017, it hit nearly $20,000, then fell 84% over the following year. Dead again. It came back. In 2022, after the FTX collapse, which was not a Bitcoin failure, it was a centralized exchange failure, which is a completely different thing. Bitcoin fell from 69,000 to 15,000, 78% drawdown. The obituaries were everywhere. And then in 2024 and 2025, institutional capital started flowing in through spot ETFs. Nation states started studying and in some cases accumulating Bitcoin. And the price reflected that shift in a way that silenced the critics one more time. None of this means that the price can't go lower from here. It can. It might. Any honest person in finance will tell you they don't know the short-term direction of any asset with certainty. But the pattern of Bitcoin's cycles, the deep drawdowns, followed by structural recoveries that establish new higher floors, is not random. It's driven by a halvening mechanism that mathematically reduces Bitcoin's new supply every 4 years, combined with a demand base that has expanded structurally with each cycle. Miners, holders, institutions, sovereign nations. The composition of who holds Bitcoin has shifted dramatically from early adopters and retail speculators to some of the largest and most sophisticated capital allocators in the world. That matters. That changes the dynamics. Let me explain something that most mainstream financial commentary completely misses about why Bitcoin is at this particular crossroads in history. We're in the early innings of what economists are starting to call a digital collateral revolution. Throughout history, the thing that backs debt, the thing that sovereign nations and banks accept as collateral, has evolved. It started with land, then gold, then government bonds. In the post-Bretton Woods era, the US dollar became the world's reserve collateral. Everything was priced in it. Every major trade settled through it. Every central bank held it. But here's what's happening now. The United States is actively weaponizing the dollar through sanctions, through swift exclusions, through financial pressure. And countries that are not aligned with Washington are watching. They watched Russia get disconnected from the global financial system in a matter of weeks. They watched the lesson play out in real time. If you hold your reserves in dollars inside the US banking system, those reserves can be frozen, confiscated, made inaccessible. Bitcoin solves that problem in a way that nothing else does. It's permissionless. No government controls the protocol. No central authority can freeze a private key. And it's globally liquid. You can transfer $1 billion worth of Bitcoin across any border in the world in 10 minutes for a few dollars in transaction fees. For nation states that want monetary sovereignty, for institutions that want an asset that exists outside the traditional financial system's counterparty risks, Bitcoin is not just an investment, it's infrastructure. You can already see this playing out. El Salvador made Bitcoin legal tender. That's symbolic, but symbols matter. More importantly, multiple U.S. states have now passed or are in the process of passing legislation allowing their governments to hold Bitcoin as a Treasury reserve asset. At the federal level in the United States, there's active political discussion about a strategic Bitcoin reserve, an idea that was considered fringe 3 years ago and is now being debated by senators and presidential candidates. Publicly traded companies, MicroStrategy, Tesla, and others, have made Bitcoin a treasury strategy, replacing cash that was being eroded by inflation with an asset that has a defined, mathematically enforced supply ceiling. The CFTC has now allowed Bitcoin to be used as collateral in derivatives markets. BlackRock, the largest asset manager in the world with over $10 trillion under management, launched a Bitcoin ETF, and within months, it became one of the fastest growing ETF products in financial history. These are not the actions of people who think Bitcoin is a fad. These are the actions of sophisticated capital allocators who have studied the asset deeply and concluded that it deserves a structural position in the modern financial system. And when BlackRock moves, other institutions follow. That's how capital allocation works. There are investment mandates, there are fiduciary requirements, and when a bellwether institution legitimizes an asset class, the doors open for thousands of other institutions to follow. Now let me talk about something that doesn't get discussed enough in the Bitcoin conversation, and it's the emerging intersection of Bitcoin and artificial intelligence. Not from a technology hype angle, but from a purely economic and structural perspective. We are at the beginning of the largest productivity disruption in human history. AI is going to reshape labor markets, compress costs, change which skills are valuable, and fundamentally alter how wealth is created and distributed. This is not speculation. The productivity gains from AI adoption are already showing up in corporate earnings, in software development timelines, in legal research, in medical diagnostics. The question isn't whether AI will change the economy. It will. The question is what it does to monetary dynamics. Here's the insight that most people are missing. As AI drives productivity and drives down the cost of goods and services, deflationary pressure builds in the real economy. But the debt overhang, those $36 trillion the US owes, those hundreds of trillions in unfunded liabilities globally, doesn't deflate with it. Governments cannot afford deflation because deflation increases the real burden of their debt. So central banks will continue to find ways to inject liquidity into the system, to keep asset prices elevated, to push nominal values higher even as real purchasing power slowly erodes. That tension, Real-world deflation from AI productivity meeting monetary inflation from debt obligations creates an environment where scarce, hard assets perform exceptionally well in real terms, even if nominal volatility remains high. Bitcoin, with its fixed supply of 21 million coins, a number that will never change regardless of what any government, central bank, or technology company decides, is arguably the most pristine, scarce asset that has ever existed. Gold is scarce, but not perfectly so. Miners find new deposits. Asteroid mining is theoretically possible. Central banks can and do sell reserves. Treasury bonds have credit risk. They're only as good as the government's willingness to repay. Real estate is location dependent, illiquid, and requires massive ongoing maintenance costs. Bitcoin is none of those things. It's globally liquid, perfectly divisible, censorship resistant, and its supply schedule is known to the decimal point for the next 100 years. In an economic environment where AI is simultaneously making human labor less valuable while governments are inflating away the purchasing power of savings, the case for owning something with perfectly inelastic supply becomes not just intellectually interesting but practically urgent. Now let's talk about what's actually happening psychologically in markets right now, because understanding crowd behavior is as important as understanding fundamentals. When prices fall sharply, and Bitcoin's falls are sharp, this is not a new phenomenon, several things happen in sequence in the average investor's mind. First comes rationalization. This is temporary. Then comes anxiety. Maybe this is more serious than I thought. Then comes fear. I should reduce my exposure. And then, at the worst possible moment, comes capitulation. I can't take it anymore. I'm selling. And then, almost invariably, the price recovers. And the person who sold at the bottom spends months watching the rally from the sidelines, paralyzed by a different fear, the fear of buying back at a higher price than they sold. This sequence has played out identically in every asset class throughout history. In 1932, at the bottom of the Great Depression stock market, the Wall Street Journal's headlines were indistinguishable in tone from the most pessimistic crypto Twitter posts you've ever read. In March 2009, at the absolute bottom of the financial crisis, the narrative was that the U.S. banking system was permanently impaired. In December 2018, at the bottom of Bitcoin's previous bear cycle, the consensus was that institutional adoption was a myth, and Bitcoin would never recover. In each case, the people who held conviction through the narrative darkness were rewarded by the structural reality that eventually reasserted itself. What is the structural reality today? It's this. Bitcoin is being integrated into the global financial system at an accelerating rate, not replaced by something else, not regulated out of existence, integrated. The spot ETFs are operating. Institutional custody solutions exist. Major accounting firms have clear guidance on how to hold and report Bitcoin on corporate balance sheets. Regulatory frameworks are being built in the US, the EU, the UK, and Asia. This is not the behavior of a financial system that's going to ban Bitcoin. This is the behavior of a financial system that's figuring out how to absorb Bitcoin into its existing infrastructure. That doesn't mean it's smooth or linear. Adoption curves are never smooth. The internet went through a complete collapse in 2001. The NASDAQ fell 78%. Thousands of companies went bankrupt. The word .com became a punchline. And then, quietly, while everyone was busy writing the obituary of the digital economy, Google was getting started, Amazon was expanding its infrastructure, Apple was developing the iPod. The companies and assets that survived the collapse and represented genuine utility didn't just recover, they went on to define the next 20 years of economic history. Bitcoin's utility is not theoretical. Every day, billions of dollars in value settle on the Bitcoin network. Every day, people in countries with broken currencies, with authoritarian governments, with limited access to traditional banking, use Bitcoin to preserve their savings, to transact across borders, to exist outside a financial system that has failed them. This is not a Silicon Valley thought experiment. This is happening in Argentina, in Nigeria, in Turkey, in Lebanon, in Venezuela, places where the local currency has lost 80, 90, sometimes 99% of its purchasing power within years. For those people, Bitcoin isn't an investment. It's financial oxygen. Let me now shift to something I think is critically important and almost completely ignored in the mainstream narrative about Bitcoin's risks. Most people focus on the volatility risk. Bitcoin goes down a lot. That's true. But let me ask you a different question. What's the risk of not owning any Bitcoin in a world where it continues its current adoption trajectory? What's the risk of holding cash in dollars when the dollar's purchasing power has fallen by more than 90% since the Federal Reserve was created in 1913? What's the risk of holding government bonds in a world where governments have a structural incentive to inflate away their debt? What's the risk of holding real estate in a world where property taxes, maintenance costs, and liquidity constraints mean it's not actually as protective as most people assume? Risk is not just volatility. Risk is the probability of permanent loss of purchasing power, and by that definition, the definition that actually matters for long-term financial health, cash and bonds carry enormous risk that most people have been conditioned not to see because that risk manifests slowly and without dramatic headlines. Bitcoin's risk is the opposite. It's visible. It's uncomfortable. It shows up on price charts in ways that trigger emotional responses, but the long-term trajectory, driven by the mechanics of fixed supply, growing adoption, and the macro environment of monetary debasement, is as clear a structural case as anything in finance has offered in a generation. I want to be precise about what this means strategically, because intelligence without strategy is just an interesting conversation. The way that sophisticated investors, family offices, hedge funds, institutional allocators, are thinking about Bitcoin right now is not as a speculation. They're sizing it as a structural position in a diversified portfolio. Not 100%, not 50%. But enough that if Bitcoin continues its adoption trajectory, the position is meaningful. And the sizing, whether that's 1%, 3%, 5%, 10%, is a function of individual risk tolerance, time horizon, and overall financial situation. There's no universal answer. But the philosophical framework is consistent. You're buying an option on a new monetary system, sized at a level where if it goes to zero, your overall financial life is not destroyed. But if it continues its current trajectory, the position is transformative. That's not hype. That's risk-adjusted portfolio thinking. And it's how the Paul Tudor Jones types, the Stanley Druckenmillers, the institutional money managers who have publicly disclosed Bitcoin positions, it's how they think about it. Here's something else worth sitting with. Throughout history, the hardest thing to do in investing is to hold conviction through a narrative that feels uniformly negative. When everyone around you is scared, when the financial media is producing an unending stream of pessimistic content, when your friends who don't understand Bitcoin are feeling validated by the price decline, the psychological pressure to capitulate is enormous. It's not a character flaw to feel that pressure. It's a neurological response. Human beings are wired to seek safety in numbers, to conform to consensus, to treat social proof as information. The problem is that in financial markets, the consensus is almost always wrong at the most important turning points. The crowd is almost always most bearish at the bottom and most bullish at the top. The Fear and Greed Index, which measures market sentiment through volatility, volume, social media activity, and options positioning, hit an all-time low reading of 5 out of 100 in early February 2026, the lowest ever recorded, maximum fear. And what happened at the same time? 66,940 Bitcoin flowed into accumulator addresses, the largest single-day accumulation of the entire market cycle. Goldman Sachs, tripled their BlackRock IBIT position to over $1 billion during the period of maximum fear and maximum negative headlines. These aren't retail investors reacting emotionally. These are capital allocators with billion-dollar research teams making systematic decisions based on long-term structural analysis. That contrast, maximum retail fear meeting, maximum institutional accumulation, is one of the clearest pictures of where we are in the cycle that I've seen in years. Now let me close with something that I think is the most important thing you can walk away with from this entire conversation. Bitcoin's story is not over. It's not even close to over. The total addressable market for what Bitcoin offers, a globally liquid, censorship-resistant, mathematically scarce store of value, is measured in the tens of trillions of dollars. The entire global gold market is approximately $13 trillion. Negative yielding debt at its peak was over $18 trillion. Global real estate is over $300 trillion. Even capturing a small percentage of capital that currently lives in those categories would represent multiples of Bitcoin's current market cap. That doesn't mean it happens in a straight line. It doesn't mean there won't be more volatility, more drawdowns, more moments of narrative darkness. There will be. That's part of the process. But the structural case for Bitcoin, as a response to long-term debt cycles, as a hedge against monetary debasement, as a form of digital collateral in an increasingly digital economy, as a permissionless financial network for people excluded from traditional banking, as an asset that exists outside the counterparty risk of any sovereign nation, has not weakened. If anything, it has strengthened with every year that the traditional financial system has continued to demonstrate the limitations and risks of its current structure. The question isn't whether Bitcoin matters. At this point in history, the evidence for its mattering is overwhelming. The question is whether you understand it well enough and believe in it deeply enough to hold through the periods where the price doesn't reflect the underlying reality. And that's a personal question, one that only you can answer, based on your financial situation, your time horizon, and your ability to tolerate short-term pain for long-term structural positioning. But here's what I'll say with conviction, and I'll say it without hype and without the usual performance of certainty that you see in this space. The people who are thinking about Bitcoin in 2026 the way that the sharpest minds thought about early internet infrastructure in 1996, not the bubble period, not the euphoria, but the early structural adoption period, are probably going to look back on this moment and recognize it for what it is: a recalibration, a reset of expectations, a shaking out of speculative excess that leaves behind the genuine long-term holders, the institutional capital that has studied the asset seriously, and the growing base of people around the world for whom Bitcoin is not an investment thesis but a financial necessity. History doesn't repeat, but it rhymes. And if you've studied it carefully, the 1929 crash and the subsequent recovery, the 2000 dot-com collapse and the emergence of the modern internet economy, the 2008 financial crisis, and the decade of asset price inflation that followed, you know that the most significant long-term opportunities in finance almost always show up wearing the costume of a catastrophe. They feel terrible in the moment. They shake out the weak hands, and then the structure reasserts itself. That structure, Bitcoin's fixed supply, its growing institutional adoption, its role as digital collateral in an increasingly digital and increasingly indebted world, is not broken. It's intact. And for the people who can hold that understanding without letting fear override their analysis, this moment may be exactly what it looks like in hindsight. Not the end of something, but the middle of something, much larger than any of us fully appreciate in real time. Stay patient. Stay educated, stay rational, and if you haven't already, start doing the work to understand this asset at the level it deserves. Not because someone told you to, not because the price went up, but because the macro environment we're navigating right now demands that every serious person thinks clearly about where real value lives and where it's quietly being transferred from those who don't understand to those who do. That transfer is happening right now. And unlike most things in finance, the mechanism, the fixed supply, the growing adoption, the institutional integration, the macro tailwinds, is not hidden. It's in plain sight for those who choose to see it. This is not financial advice. Do your own research. Think for yourself, but think clearly. And let me leave you with one final thought, one that I think matters more than any price chart or market analysis. Every major shift in how human civilization stores and transfers value has been met with skepticism, institutional resistance, and a period of painful volatility before it became the obvious new standard. The transition from commodity money to paper currency was resisted fiercely. The transition from physical gold to the gold-backed dollar at Bretton Woods was negotiated under enormous geopolitical pressure. The transition from paper checks to digital bank transfers was considered by many to be a security risk not worth taking. Each of those transitions, in hindsight, looks inevitable. At the time, each of them was genuinely uncertain, genuinely uncomfortable, and genuinely controversial. We are in the early stages of another transition, from analog stores of value to a digital one that is native to the internet age. Bitcoin is the first credible, decentralized, mathematically sound form of digital scarcity that the world has ever seen. It is roughly 12 years old as an institutional asset. 12 years. The U.S. equity market is over 200 years old. The gold market has existed for millennia. The Federal Reserve was founded in 1913. By those standards, Bitcoin is in its absolute infancy as a recognized financial asset class, and yet it already carries a market cap measured in the trillions, a regulatory framework taking shape across the world's most important jurisdictions, and a growing roster of sovereign nations, Fortune 500 companies, and multi-billion-dollar investment funds treating it as a permanent component of their capital structure. That trajectory, from cypherpunk experiment in 2009 to institutional balance sheet asset in 2026, is not an accident. It's the market discovering, slowly and sometimes painfully, that this technology solves a problem that the traditional financial system cannot solve: how to store value in a form that is simultaneously global, liquid, scarce, and beyond the reach of any single government's ability to inflate, confiscate, or control. Now let me be precise about the counter-arguments, because intellectual honesty demands it. There are legitimate risks to Bitcoin that serious people take seriously, and they deserve honest treatment rather than dismissal. Regulatory risk is real. A concerted effort by major nations to restrict or meaningfully constrain Bitcoin's accessibility could impair its short-term price and adoption trajectory significantly. I think this is increasingly unlikely given the depth of institutional integration that already exists. Bitcoin is now embedded in the portfolios of too many large institutions for governments to simply outlaw it without triggering serious economic and political backlash, but it is not impossible. Governments do not always respond to financial threats rationally, and there are scenarios where political pressure to control monetary systems leads to restrictive policy that surprises the market. Technological risk exists. Quantum computing, if it develops faster than Bitcoin's cryptographic defenses can be upgraded to meet it, could theoretically threaten the security of older wallets. The Bitcoin development community is aware of this, and work on post-quantum cryptographic standards is ongoing, but it remains a tail risk worth acknowledging clearly rather than waving away. Competition risk is sometimes raised. Could a different cryptocurrency displace Bitcoin as the dominant digital store of value? Theoretically possible. Practically, however, Bitcoin's network effect, the combination of its security, its liquidity, its global recognizability, and its institutional adoption, grows harder, not easier, to displace with each passing year. The analogy to gold versus other precious metals is imperfect but instructive. Platinum is rarer than gold, but gold is gold. The social consensus around its monetary role has been self-reinforcing for thousands of years. Bitcoin is developing a similar layer of social consensus around digital monetary scarcity that becomes more durable with every year of its survival. These risks don't disappear because Bitcoin's structural thesis is compelling. They exist, they're worth understanding. And they're precisely why the appropriate position for most people is not everything they own, but a thoughtful allocation that reflects the potential and the genuine uncertainty simultaneously. Here is what I want you to carry forward from everything we've talked about. The financial system we were all born into, central banks, fiat currencies, government debt as the risk-free benchmark, inflation as an accepted feature rather than a bug, is not a permanent feature of human civilization. It is a specific configuration designed in specific historical circumstances, and it has a lifespan, just like every monetary system that preceded it. When it transitions, and history is unambiguous that all monetary systems do transition, on timelines that nobody can predict with precision, the assets that survive and thrive will be the ones with genuine, durable utility that does not depend on any single government's continued operation or any central bank's continued competence. Bitcoin was designed precisely for this transition, not as a prediction that the current system collapses tomorrow, not as a bet on any specific geopolitical outcome, but as a form of financial insurance, a stake in an alternative monetary system that runs parallel to the traditional one that grows stronger every day. Traditional institutions demonstrate the structural limitations of their architecture, and that offers something the current system cannot: a unit of account whose supply is governed by mathematics rather than by the political incentives of whoever happens to hold power. In 1971, when Nixon closed the gold window and severed the dollar's last connection to physical gold, he changed the monetary architecture of the world in a single announcement. Most people at the time had no clear sense of what it meant long term. The implications played out over years, then decades, in the inflation of the 1970s, in the real estate and equity bubbles that followed, in the growing gap between those who owned hard assets and those who didn't. The people who understood 1971 as a fundamental structural shift, not just a policy adjustment, and who positioned accordingly, were the ones who defined the next generation of wealth. 2009, when Satoshi Nakamoto launched the Bitcoin network, may eventually be recognized with the same significance. Not by everyone right now, not in the mainstream narrative right now, but by historians studying the evolution of money. It may stand as the moment when the first serious, durable alternative to government-controlled currency appeared, proved it could survive without a central authority, and began its slow but unmistakable journey toward becoming a globally recognized monetary asset. We are not at the beginning of that story anymore, but we are almost certainly not near its end either. The next 5 to 10 years will likely be the period that determines whether Bitcoin completes its integration into the global financial system, running alongside gold, alongside dollars, but sovereign from any single nation's control, or whether some combination of regulatory pressure, black swan risk, or competitive disruption alters that trajectory. My honest assessment, based on the institutional adoption already embedded in the market structure, the regulatory frameworks actively being constructed, the macro environment that structurally benefits scarce assets, and the accelerating pace of Bitcoin's integration into mainstream financial infrastructure, is that completion of that journey is more probable than not. Not guaranteed, not certain, but structurally probable in a way that becomes more supported by evidence with each passing year. And for those who share that assessment after doing their own work and reaching their own conclusions, the question is not whether to understand Bitcoin and its place in the financial system's evolution. The question is how clearly, how patiently, and with what level of intellectual rigor you pursue that understanding before the next chapter of adoption makes this moment look obvious in retrospect. The chance to think clearly about this before it becomes full consensus, before the institutional integration is complete, before the mainstream narrative has caught up to the structural reality, still exists. That window doesn't stay open indefinitely, but it's open right now. Use it well, think carefully, and never let the noise of short-term price volatility drown out the signal of long-term structural change. This is not financial advice. Do your own research. Think for yourself, but think clearly.